All right, we'll go ahead and get started here. This is Caleb Pearson with Compass Financial Services, and I will be the host of today's webinar. Today, we're going to be talking about college savings and what your options are, and we'll dive more deeply into 529 plans specifically. And Guy Leman and Justin Van Houten will be giving the broad overview of these topics. There will be a brief question and answer at the end. So if you do have a question, you can respond to the email that I sent you with the link to today's webinar, or you can email me directly at caleb.pearson@compassiowa.com, or you can actually text us at our office line here at 515-327-1020. We are recording today's presentation, so if you have to hop off for whatever reason, or if you want to share it, after the presentation, I'll send a link to the recording afterwards to everybody who registered. So, and we'll also send out some materials that will be discussed today, as well as a copy of the PowerPoint presentation. So don't feel like you need to scribble down a bunch of notes. There's some good information in here, and we'll make sure you get a hold of it after the presentation. So you should be able to see our presentation up on your screen right now, and then a video of whoever is speaking. And if for some reason you can't see the presentation, you should be able to just click on in the upper right-hand corner a way to switch views so that you're able to see that. To get started here, I am required to read the disclosure that you see on your screen right now. Financial planning and investment advice offered through Compass Financial Services, a registered investment advisor and separate entity from LPL Financial. Securities offered through LPL Financial, member FINRA, SIPC. So to get started here, we'll go ahead and have Guy. Guy, if you go ahead and unmute yourself.
All right, thank you, Caleb. This came together because we get an awful lot of questions on college savings. How do I do it? When to start? Which vehicles are the most appropriate? And really, how do you handle the overall strategy of college expense? And really, it's about taking the concentrated expense of 4 to 5 years of college for a kid and really spreading it out over the course of 20 and even 30 years. And what that means is, as early as you can, getting some savings started in a plan, and we'll talk about the various options, but starting as early as possible, even with something. And then when you get to college, cash flow in college, right? How much of my daily income, monthly income am I going to put towards this? It becomes another line item in your budget. And then afterwards, right, how much debt have we incurred from the college years, and how do we help our kids handle that? Or how do, so basically spreading that concentrated expense over a very long period of time. So Justin's going to talk really high level here at the beginning of the presentation about the educational landscape, and then we're going to dig into 529 plans and the other ways of saving for college.
Thanks, Guy. And so as we get started here, a question we sometimes get is college education still worth it? And there are some industries or some jobs where you may not need college education and you can do very well. But what you're seeing here is a study that was done showing the average salaries for different degree levels or education levels. And as you can see kind of on the right here, if you have a high school education, for instance, the median or average salary is almost $39,000. If you have a bachelor's degree, it's around $65,000. And it goes up from there with master's degrees and professional designations. So there is still some value in higher education. And the other thing that's really important here that this illustrates is the light blue line you see running along the bottom. And that is the unemployment rate for these different degree levels. And one thing that you get with higher education is you are much more attractive when you're out in the job market. And so if you think about how things are now, there's a lot of people that change jobs, change careers, something unexpected like COVID can happen. And in the future, that'll probably only increase in terms of people moving around with jobs. And so being as attractive as possible to a potential employer with a higher education level will definitely serve you well. And so that's kind of the two key points to take away from this graph. Looking at this next graph, the big thing that you may already be aware of if you're watching this webinar, but college expenses are increasing. They are inflating at a very high rate, a rate that is higher than the general US inflation rate. So as we look at these years along the bottom, the dark blue column is the pace of inflation for college or higher education, and the light blue is the general US inflation. So routinely, college education, the price is increasing at a rate much higher than we're seeing in other areas of the economy. And as we look at the next slide, it will dig a little deeper into this. And there are some common household expenses that we all have here at the bottom. We all spend money on gasoline, food, healthcare, and this study looks at for the past a little over 30 years, and it shows the rate that some of these costs that we all have inflated. And at the top of the list, as you can see on the left, is tuition, far outpacing even healthcare, which we all know is getting expensive. And there's a few reasons for that we'll get into. One is just simply competition for resources among the different educational institutions. And another reason is, especially when we're talking about public or state institutions, they are receiving less support at the state level, which means there's a larger price tag or a larger expense that they are now passing on to the consumer or the person being educated. And so we've just been talking about the cost of tuition, but of course, when you go to college, there are costs that go far beyond tuition, books and supplies, room and board, additional fees, a semester abroad, technology, transportation. There's a lot of costs that get associated with college. And so as we start talking about ways to handle these costs, the information we'll give you today is going to help manage this in a way where you're not just focused on tuition, but you can help pay for any other type of a qualified expense for college. And what this graph here is showing is the dark blue columns that you see. That is the available financial aid at different time periods, going back to 2010 through 2018, 2019. And so you can see these blue columns are shrinking over time, and that's the amount of financial aid that is available to students. The light blue line is the increase in price of college that we've been talking about. And so what you're seeing here is there's a growing spread or gap between college expenses and the amount of aid available. College expenses have increased 15%, aid available has decreased by 12. So today, as we're talking about this and educating on some different options, primarily 529s, the idea and the goal, as Guy mentioned on the front end, is to start finding ways to fill this gap and do it in a way where you can spread it out over time.
All right, so now we're going to dive into a 529 plan. And a lot of people know about 529s, but may not know how truly flexible they are. 529 is a type of plan that was created specifically for educational savings. And let's talk about this. It offers all sorts of flexibility, and the flexibility has actually been expanding in recent years, and we'll hit on that too. So the first one is there are certain tax benefits. One of the tax benefits is a potential deduction in the state that you live. So in Iowa, our deductibility limit, if you contribute to a 529 plan, an Iowa 529 plan, you can deduct about $3,400 per year per kid against your state of Iowa income taxes. Okay, so that's kind of the first benefit. The second benefit is once you put money in these accounts and they have investments in them so they can grow, And if you use that growth over time for a qualified educational expense, then you don't have to pay taxes on that. So earnings grow tax deferred, and qualified withdrawals are tax free. Now, the other nice thing with tax benefits is there's no requirement that you have to take money out, and there's no time limit for these 529 plans. Other areas of flexibility are gifting and estate planning. You can put up to $15,000 per kid per year into these plans. However, only about $4,300 is deductible per year. And you can also put much larger amounts too and spread that over a number of years. You can take withdrawals, and the proceeds can be used for eligible institutions, not just in Iowa, all over the country, and even some international. So you can use these very broadly and widely. There's very few restrictions on how you use them, as long as it's a qualified educational expense. And then availability. Anybody can open these. Grandparents can open them. You can open them for yourself. But remember, there's always two parties in the 529 plans. There is an owner, and then there is a beneficiary. And so let's keep going here and talking about the other ways more recently that 529 plans have been increasing in flexibility. In the past, it was just for post-secondary education, meaning college, trade schools, vocational schools, things like that. A 2018 law included K through 12 tuition, primarily private school tuition. So the same sort of benefits are now available for those that have kids in private school or have tuition associated or costs associated with even the public school system you're in. So great flexibility, really open things up. Now, there's a lot of question out there about actually what is a qualified educational expense, and therefore you can remove money out without paying taxes on the growth, right? One of the tax benefits. So again, this is kind of like Justin talked about. There's tuition and there's room and board, right? Even off-campus housing. Those can be covered, the two specifically, housing and food, right? Room and board can be covered, but you must be at least half-time to have those qualify as qualified educational expenses. And it's not just colleges or junior colleges, it's also vocational schools, trade schools, and it even gets so broad as books and computers, and even sometimes dorm room furniture. So it's really a broad, it includes fees, application fees, activity fees, charges, all the ancillary stuff that all go into being enrolled and getting educated post-secondary or K through 12, frankly. And another addition that was added in 2019 in a law passed then was not can it just pay for those qualified educational expenses while you're being educated or while your children are being educated. You can actually use up to $10,000 per kid over their lifetime to pay off student debt. Okay, so this is also a big addition. And again, it makes this 529 tool extremely effective because you can add to it all those years before you get to need it when the kid goes to college, through college, and now even after college to help handle some debt.
Picking up on what Guy was talking about, there can be some tax benefits associated with contributions to a 529 plan. But one thing to keep in mind is it's state specific. So in the state of Iowa, the big takeaway for anyone living in Iowa right now is if you want to receive the tax deduction that we're talking about here, the $3,400 a year in a given 529 account, you need to open the Iowa 529 plan for that to happen. All these different states you see here have plans, and they all have different rules. one other common question we get is if you open a 529 plan in, let's say, the state of Iowa, does that mean that the student is limited to attending institutions in the state of Iowa? And the answer to that is no. The only reason you would open it up in the state of Iowa is to receive that tax deduction, but the student can go to any institution in any other state and even some international colleges. So the 529 plan itself, every state has one. They're all a little different, but you can take them anywhere in terms of your education. And the big takeaway is to receive the tax deduction in Iowa, you'd want to open the Iowa 529 plan. And as we talk about 529s, they are an investment account. You have choices in terms of how the contributions you make are invested. So some people have a do-it-yourself approach. Some people solicit an advisor to help them and give them some guidance. A common approach in these types of funds is a age-based or a target date strategy. And that would be similar to what many people may have or may have seen in their retirement accounts in their working years. And so what you see at the bottom of this graph is the years to enrollment. And where the white target date line is, that's year one of college. And so in the early years, these types of strategies are going to be more aggressive. You have a longer time horizon, you can take more risk. So they're going to be very stock heavy, and it'll be a mix of stocks, US and international. And as time comes on and you get closer to that college date, you've been building this nest egg, you've been accumulating funds, and now you start to get a little more conservative with them, and some of those stocks start to drop off, and you see the darker blue shade, that's conservative investments, fixed income. They become a bigger piece of the portfolio with the thought that now you've grown this nest egg, and now we want to protect it and make sure it's there to pay for college. And another thing to note, as Guy's been talking about, is spreading these costs out over long periods of time. So you can start a 529 at any time. And so as this shows, you can have a lot of years prior to college where you're starting to build this and these investments are compounding and growing. But then also after year zero, you can still continue to contribute. This can still grow throughout college. And then even beyond college, with the 2019 law that was passed, where now some of these funds can even be used to pay up to $10,000 off in student loans. Another question or another scenario that we run into sometimes is grandparents who are starting to look at doing some estate planning, and maybe they're considering making a gift to their sons or daughters or maybe even grandkids. And a 529 plan is a great way if they want to pass on some of that generational wealth. There's some tax benefit for them, like if you do it in the state of Iowa, but also now you're getting some money into an account for that beneficiary, in this case a grandchild, and it's going to be able to grow and compound over time in a tax advantaged way. And another area where 529s may be an option is when people reach the age of 72, and some of you are going to be familiar with this, but any type of a qualified account. So your IRA accounts or any work plans, those are qualified accounts where you've put pre-tax dollars into them and they've been allowed to grow tax-free. When you reach age 72, the IRS says they would like to start receiving some of the tax associated with that money. And so there's minimum distributions that are required that you have to take every year. Many people use these anyways because at that age, they're taking that as income for their monthly living expenses. But we do run into situations where clients are forced to take a required minimum distribution by the IRS, and they don't have a need for that money. And there's a couple options here, and that's what you see. Option A is just taking that money and putting it into a non-qualified account or a after-tax investment account and letting it grow that way. The growth that occurs there, you will pay taxes on going forward. And another option, option B, is to take this same required minimum distribution and put it into a 529 plan, where once again, you're helping someone out. you don't necessarily need the money anyways. And it's also going to be able to grow tax deferred, and down the road, as long as it's used for the qualified expenses that Guy talked about, there's a nice tax advantage there that you don't get in a traditional investment account. So another question or myth that we sometimes see is, will financial aid be impacted by having a 529 account? And the short answer is yes, it will slightly, but it's not proportional. And so you see two strategies on the screen. On the left is kind of a traditional, a lot of loans, 75% loan, 25% financial aid. On the right is a situation where they have 40% covered in a 529 plan, which now reduces the amount of loan and the amount of financial aid. When a student is entering higher education, they fill out what's known as a FAFSA. And I won't get into the weeds too much, but that's a free application for federal student aid. And it's based on a number of factors, but one of the primary things they will look at is the income of a parent. And so they will look at 529s, but the maximum amount that impacts the formula they use is a little over 5%. So in other words, and that's what you see, the 5% decrease here is basically depending on incomes and some different variables, the biggest impact or the loss that you could have in financial aid is a little over 5%. And you can see the gain by having this 529 far surpasses that. And one other thing with this, if grandparents have a 529 opened and they're the owner of it and the beneficiary is a grandchild, grandparents' income does not factor into the FAFSA. So in that situation, there is no decrease in the aid that's available. And the final slide here we want to look at on this topic is just simply 3 scenarios with someone funding college fully from a 529, someone 50% 529, 50% student loan, and finally 100% student loans. And in this example, 4 years of college is estimated to be about $104,000. And the example on the left, the heading 100% through 529 plan, this family is investing $247 a month for 18 years, kind of a somewhat average rate of return of 7%. And in that time, their total investment is a little over $53,000. So that's how much they've contributed. That will grow to $104,000 in this case, which will take care of tuition. And so at the very bottom, you see their total out-of-pocket expense is $53,000. Now let's say we cut that in half and we look at the middle scenario. So now instead of contributing $247, they're contributing $123 with all the same variables. That means they've contributed $26,000 over the course of this. And when we plug that in, that means that there's some loan left. So they're going to take a loan of about $63,000. That's the bold part at the bottom. And the orange number is their total out of pocket. And now that's increased from, in the first scenario, $53,000 to now $90,000. We contributed some and we had some savings there, but we still added in some loans. The last scenario is 100% student loans. As you would imagine, this is very costly. There's no contributions on the front end. There's no 529 plan. And you are paying for the whole cost of education with strictly student loans. And now that total out of pocket at the bottom, you see there's $127,000. So this just kind of illustrates the importance of a 529 plan and how it can really allow someone to come out of their education either debt-free or with a lot less debt. And now they can take off on their other financial goals a lot sooner. And then a second thing that we sometimes see is people wonder, do they just need one 529 plan for a whole family if there's multiple kids? Or sometimes, should they have more than one 529 plan? And the short answer is we would recommend that you have a 529 plan for each child. Could you use one 529 plan and change beneficiaries? You certainly can. There's some disadvantages to that though. We talked about the tax deductions that you get earlier on in the presentation. Well, that tax deduction, if you open a 529 plan for each kid, you can get that tax deduction for each kid. So that's one advantage. And the second thing to think about is we talked about how we're going to invest these 529s and the time horizon between when we're starting this account and when someone's going to start using it in college. If you have multiple kids on the same plan, you're going to have to invest it in a way that works for the first kid. And those kids that have a longer time horizon, they're going to be in conservative investments that aren't really ideal for them. So obviously, if you open a 529 plan for each of the kids, now you can invest it in a way that matches up with their timeline. So our recommendation is you would have a 529 for each kid as opposed to just one family 529 plan. And Guy, I think you have a great example of that.
Yeah, so let's look at an example of this couple here in this slide, right? Husband and wife, 3 little kids. And the example is that each, the husband and the wife, can have their own individual 529 plans for each kid. So let's take the example that the wife opens up one 529 for each of her 3 kids in the state of Iowa, and they live in Iowa, so that makes sense. She can contribute up to $3,400 per kid per year and deduct that from her state of Iowa income taxes, right? This is not a federal deduction. This is a state of Iowa income deduction. So she could potentially, if the wife opened up 3 accounts and maxed out those 3 accounts to the limits, she could put in $10,200. That would lower her Iowa income $10,200 on her taxes. And that money would go in, and if it had any growth, whenever she took it out, she could avoid paying any taxes on the growth as long as it was for a qualified educational expense. And if they have even more money they wanted to save towards college, then the husband could also open an individual account for all 3 kids, do the same amounts. So potentially they could put as much as $20,400 and have that count as a deduction against their state of Iowa income taxes. The next slide talks about that there are other options for college savings. Of course, there's 529s, which have been specifically designed for educational savings and have these great tax benefits. There's educational savings accounts, which have much smaller limits. There's UTMA accounts, UTMA, and those are basically custodial accounts. Those are accounts that minors own, but since minors can't be legally titled in assets, they need a custodian listed on the account or someone that's over the age of majority to make decisions for them. And then at the end, there's a taxable savings account where you just take your after-tax money in your checking account and you plug it into a bank or a general investment account and save that way. The whole point here is that these 3 options don't have the tax advantages that 529 plans have, right? The tax-free growth, and they don't have the flexibility. So that's the main point I want to make about really all the other alternatives is those you don't have the tax advantages and you don't have the flexibility, which in the end make it to be a really big deal. In fact, in 2 slides, it shows, right here, it shows a 529 plan compared to like just putting money in a general investment account. So you see growth over 6 years, right? The light blue is the general investment account, taxable savings account, and the dark blue is the 529. And the issue there is, right, if you put $1 into a taxable account and it grows to 2, and when you remove that money, you're gonna owe income taxes on the dollar's worth of growth. And that's gonna be a drag over time. That's gonna give you less dollars at the end of it to spend on educational expenses. So the beauty of the 529 is really the advantages of money going in, the advantages of money coming out, and getting a deduction on the front end and owing no taxes on the growth when the money comes out. Okay, We're going to open it up to questions now. Caleb, you've been fielding questions via email. Do you have some for us?
Yes, yep. So one of the questions that came in is what happens if one of your kids gets a scholarship? We did talk a little bit about, you know, paying off student loans at the end, but what if your student, the beneficiary on the account gets a scholarship? So Justin, you want to tackle that one?
Yeah, sure, Caleb. So you have a couple options if you're fortunate enough to have a scholarship to help cushion the blow of college, or maybe even a full scholarship. One thing you can do is you can change the beneficiary on the 529. So maybe your oldest gets a scholarship and you want to just retitle the 529 and make the beneficiary your next oldest child. That's an option. Also, when the child qualifies for a scholarship, you have the option of pulling that amount of money back out of the 529 with no penalties associated for it. And just with the general thought that that money was intended for college, and now that the scholarship is solving for that amount of money you can pull back now and be penalty free with it. So you have a couple options there that are both good.
Okay, great. And then what happens if, say, a student goes to school, you use as much as you can from the 529 plan to pay for school, but they end up graduating and they don't have any student loan debt and there's still money left over in the 529? This kind of goes along with that. Justin, how would you answer that question?
Yeah, so they have a few options there. If at the end of the day, and Guy, I think this is something you wanted to touch on too, but
Yeah, so I'll answer this question. If you have money left over in a 529 and all your educational expenses are done for your kids, again, you have the same option of changing a beneficiary, keeping the account, but changing the beneficiary to a grandchild. You can use it yourself, right? You can be the owner and the beneficiary. Whoever you see in the near future needing some educational help. But if at the end of the day you have money in 529 plans and you just want to take it out and be done with 529 plans, there's two items. You're going to owe taxes on the gains, and you're going to owe a 10% penalty to the IRS for taking money out that for its unintended purpose. So let's say you have an account that's worth $10,000 and you don't need it anymore, and time comes to take it out. You're going to owe a $1,000 penalty to take that money out. In addition, you're going to owe taxes on whatever the gain you've had in that account, right? Which is the difference between how much you put in and what it's currently worth right now. So there are some penalties, but at the end of the day, those are the options if you have money left over.
Okay, great. Thank you. A couple questions came in that we covered in the presentation. Can you use a 529 for either a 2 or 4 year university? The answer is yes. Same with a trade or technical college. Yes. What if they decide not to go to college? What can you do with the money? We kind of talked about it just now with what Guy was saying. You can either change the beneficiary on the account, you can hold it, and if you yourself want to go back to school, get a degree in something, you use it for yourself. If you don't use it for any qualified expenses and there's no scholarships or anything like that to offset it, you do have to pay taxes and penalties on the gained portion of the portfolio.
Yep.
Then let's see, record keeping. Guy, what do you need to keep in mind about record keeping?
Yeah, so this is a little bit of the wild, wild west. People don't really know how to handle this very well, but all the record keeping responsibility is up to the owner. So it's up to you as the owner of the 529 plan to be able to prove that you're using this money when you pull it out for qualified educational expenses. And if you ever get audited or questioned on this, we really recommend matching up your withdrawals with your bills that you're paying. So for instance, let's say the U bill is $10,253 for the semester. Well, we would suggest you go make a withdrawal from your 529 plan for exactly that amount. And then when you pay it, you can put those two pieces together, the bill and the withdraw. And so you can prove at some point this is exactly what it was used for. And it goes into a folder and you keep that for a long, long time, probably 7 years. So record keeping is all your responsibility. You cannot really rely on the 529 company to be able to prove things for you.
And something along those lines as well, which we ran into some in 2020, is if you take money out of the 529 plan and you're anticipating expenses to be a certain amount and expenses end up being less or you get reimbursed. So like in 2020, for example, if you paid for the full year of room and board, but they ended up reimbursing a bunch of the room and board because they weren't having in-person classes, you can put that amount back into the 529 plan. And the record keeping becomes very important in those scenarios because like I just said, they're not going to keep track of it on their end. So you need to make sure you keep all the documentation, so you can prove if the IRS ever comes knocking on your door that you put the money back in because you got reimbursed, and make sure those dollar amounts all line up.
There's some practical things too. You can get money out of the 529 in several ways. You can request that the 529 pay the university or school directly. Okay, you'll still want to track the paperwork on that. You can call in and have them send you the check that's going to reimburse you because you're going to write it out of your personal checking account. And so the logistics of actually getting the money are pretty varied and you have a lot of flexibility.
Great. Another question that came in is about states, and we touched on this a few times in the presentation about, where should you open one, where can it be used? If you live in the state of Iowa, the benefit, as we've touched on multiple times, of contributing to the Iowa 529 plan is the tax deduction. But say you live in a state, and that map was on one of the previous slides, where you don't get a tax deduction, do I have to use my state's plan, or can I use another state's plan? The answer is you can use any state's plan that you want. And again, if you live in Iowa, you have to use Iowa's to get the tax deduction. But if you're not getting a tax benefit, then you can use whatever plans you want. And you can do your research. And we've done this before for people who live in states where they don't get the tax benefit. There are other plans out there that may have lower costs or better investment options, and you can open a plan really in any state. And then again, you can use the money from the 529 plan in any state at any college. And there are databases out there that you can search to make sure that the university that you're going to qualifies for the 529, the expenses qualify for the 529 plans. So that's all work that you can do and research you can do, but by far the majority of the institutions in the United States are available to use with the 529 plans.
Yeah.
The last question that I got here is, how do I open one? Which is a great question. For the state of Iowa, you have two options. One, you can go through an advisor office like ourselves to open one. The drawback to that is you're going to be paying more in fees to do that, to have an advisor manage those assets. We typically have our clients open up a 529 plan through the state of Iowa. The fees are quite a bit lower, and we can help them setting it up, and you can pay for our time to do that. The website is collegesavingsiowa.com. That's where you can go and read about it, figure out, there's this PDF that we'll send out that kind of outlines the program as a whole and kind of defines better what qualified expenses are and all of that. But going back a slide, if you have any questions about 529 plans as a whole, not only just 529 plans, but how you structure paying for your kids' college, and what portion do you do from self-funding through 529? How much do you do through loans? How much do you do through just paying through your cash flow? We can help with all of that work, and that's a part of the planning process that we do here at Compass.
Well, I want to just give some encouragement because we have walked alongside lots of people that have traveled this whole path, from saving for many years to getting their kids enrolled and then drawing their 529. And many parents, you know, do a lot of hand wringing over paying for college, and will tell you almost everybody does it fairly successfully because the child has a big role in how expensive college is. The parents have a big role in how expensive the college is, and just making those decisions and navigating through that. So my encouragement is it's going to work out, but it does take some planning.
Okay, great. It looks like all of the questions we had today. Thank you all again for taking the time to join us today. If you have questions, you can email your Compass advisor here or visit our website. If you don't know anyone here, you can go to our website and find our contact information there. And again, you'll get an email from me with a copy of this presentation as well as a recording of the presentation. Again, feel free to forward that on to anyone who you think would benefit from hearing or seeing this. And if you have questions, don't hesitate to reach out. Thank you.